Hello world, it's Lee coming to you live from Boomtown again in Boulder, Colorado. It's been a long day, it's been a long couple of days, and I'm here with Toby and Jose, the co-founders of Boomtown. Welcome, fellas.
Thank you.
Thanks for having us.
Thanks for talking with Beach City. So we had the Startup Catalyst guys in here this morning, and you did a great presentation and talking to them about accelerators. I'm really interested. You guys have been around for 23 years. Is that right? Is that
23 years? No. We've been for 4.5 years.
4.5 years.
I'm 23 years old.
Oh, you're 23 years old.
Yeah.
That's where I got it mixed up. So I asked someone before, and they said, 23 years. And I thought,
Well, I mean, I've been in startups for 23 years,
right.
working in startups, but the accelerator is 4.5 years old.
Right, okay.
Yeah.
So tell us, when you started in Boulder 4.5 years ago, how many accelerators were here?
There was just one in town. There was one accelerator in town, which is Techstars. And fast forward 4.5 years later, we've done 10 cohorts, and there are now 22 accelerators in the Denver Boulder region.
And there's actually probably about 2,000 on the planet now.
Yeah, so it's a little bit of a look. I wouldn't. It's not a pet hate of mine, but it's a frustration of mine because I see, particularly in the Australian ecosystem, every man and his dog, as we would say, has an accelerator, right? And everybody's going to have the next accelerator. And one of the things that I struggle with is I'm saying, well, what's the output here? Like, what's the bang for buck? If we measured this in terms of the government money that's poured into these accelerators, how do we know whether we're getting a return on it?
I think this is a great question. So we are probably the most cynical people you'll ever meet about accelerators.
Okay, well, that's good. So
yeah,
there's three cynics here.
We would argue that the vast majority of accelerators, over 90%, are not actually doing a great job for their primary customer. Their primary customer is the entrepreneur. But the truth is that the whole accelerator category has evolved just like any other business category would, with an initial business model that are about 12 years old now, that's suboptimal for entrepreneurs. It's great for investors. It's a very kind of power law business model, which is to say, the way that the first wave accelerators make money is that they distribute a lot of bets. It's all about as many deals as they can get and spreading small bets. And then the few that make it, the very few that make it, doubling down and tripling down. Turns out that's a great model. It's maybe not a great model, but it's a good model for investors. Not a great model for entrepreneurs, because those 99% of the companies that don't make it are entrepreneurs that didn't get what they needed to make it.
Yeah.
It's a myth, actually, that the amount of money that you raise actually helps you. The data suggests that the more money you raise as a seed in your seed round and in your A round, the less likely you are to succeed.
Right.
So what we believe is that the models need to shift to where they're really giving the entrepreneurs what they need, which is hands-on, custom-tailored programming and advice.
Yeah.
And there's lots more there that I could talk about.
Yeah, no, that's really interesting. So one of my observations in the Australian market is that everybody says, we're going to start an accelerator. We're immature in terms of ecosystem development. Again, I see lots of people saying, accelerator. And, the cynic in me says, this is more about capturing deal flow and accessing deal flow.
100%. And we actually believe that you could be launching an accelerator, counterintuitively, you could think launching an accelerator in your town, maybe in somewhere more remote in Australia, away from the big cities, would be a good thing for economic development. But the truth is that over the history of humankind, innovation, art, culture, big shifts forward have always happened in geographic locations that have brought these like-minded, creative-minded people together. And so if you basically come up with the idea that you can do entrepreneurship anywhere on the planet, you're creating noise. And instead of sending your entrepreneur to an ecosystem that's thriving and has positive feedback loops, you're actually taking them out of that and putting them into an ecosystem that doesn't have the parts yet. These ecosystems have to evolve over time. So you can tell we're very cynical about accelerators.
Yeah.
It's really easy to prop one up and say you're an accelerator, but you might actually be harming the actual people you're trying to serve.
Yeah. So one of the other things I suppose from my observation of the accelerators is that a lot of them are teaching. They come out with a pitch book, That's what they come out with. A hockey stick, a hockey stick forecast, and a pitch book. And I'm saying, well, shouldn't we be teaching these entrepreneurs how to sell and get a customer? One of my favourite sayings is, what's better than an investor? It's a customer, right? That's the validation. Getting your wallet out, putting money on the table is the only validation for my mind that proves that you've got something. What's your thoughts, Jose, on that?
It's difficult for accelerators to really focus on that when you've got so much of the industry focused on fundraising. So much of the industry's metrics of success and how accelerators measure how good they are at what they do is how much money your portfolio, your alumni have raised across the board, which I've yet to see anybody report on how much they've raised in revenue, how much money their portfolio's made. But what really determines a successful company, how much they're able to promise to investors they're going to do or how much they actually do. And so I completely agree. That's one of the things we really focus on, is getting companies to product market fit and getting them appropriately capitalized, not just helping them, put, lipstick on a pig and pretty them up and get them in front of, thousands of investors to raise money. If that's what they need, then great. But first and foremost, we're trying to make sure that their businesses are real companies. They understand their customer intimately. They understand their problems, that they're chief investigators about the problem that they're going after, and then figure out a solution. And once they realize that there's a business there, that there's money to be made, because you can find a product market fit and find a solution to a problem and still there's no money to be made there, right? Everyone can buy something, but you're making a loss on every product.
If I can just add on to that real quickly, one of the problems with accelerators is that the way we measure ourselves is the wrong type of measurements. We measure ourselves on the metrics that a venture fund would measure themselves on.
Correct.
How much money has your portfolio raised? What are the valuations? And those aren't what that's not how that doesn't represent the best accelerator. Jose was mentioning, or I think he started to mention, last year, the Boomtown portfolio, which is almost 80 companies, generated more.
88 companies.
Yes.
Yeah.
Generated more in revenues than they did than they've raised in capital since their beginning, and they've raised over $50 million. Right. So we think that's a better metric to be measuring as an accelerator. How much money is your portfolio generating in revenue, and relative to the amount of capital they're raising? Because also, if you focus on raising capital, you dilute the founders and they lose control of their company. If you really care about the founders, you want them to maintain as much control as possible.
Yeah. So, I mean, I agree 100%. And I suppose from my perspective, it's about how do we build entrepreneurial capability into our people or aspirational entrepreneurs. How do we build the capability? And to me, it's a lot of it's practical experience. When I started out, it was there was no accelerators, there was no VC or anything else. It was like you made up a flyer on a photocopier, a black and white photocopier, and you dropped it into post office boxes, and that was your marketing, right?
The thing is that some things don't scale well, and the accelerator model was a way to scale entrepreneurship. And I think it is you're seeing the limitations on that. Since you're an entrepreneur, every entrepreneur, every founder, and every startup is its own multidimensional chess match. You can't put them all together and somehow apply some sort of template and they all work. So our view is that it's very personal, it's very individual, and the way for an accelerator to help is to have more team members, more people on staff. We have 11 full-time team members for the Boomtown program. The one down the street has 2 people in program. Right. And most accelerators are extremely lean. And you have to get down with every company and roll up your sleeves and really just get down there with them and help them do the dirty work.
Yeah, yeah. So seeing how we're being, I don't want to be too cynical because it's important that, as you say, I think that
you can't be too cynical for us.
That's okay.
Just let us have it.
Well, I guess these are the questions that I've been wanting to ask, and so one of the other things that I see quite regularly is the idea of this entrepreneur in residence, and then I read the ads for an entrepreneur in residence that said, we want an entrepreneur to come in to be an entrepreneur in residence, and it's a full-time salary job, you get bonuses. That's the antithesis of an entrepreneur. What sort of an entrepreneur is applying for that job? Yeah.
I'm not sure how to speak to that. We don't have that role. We've had that role in the past, and they've kind of shifted. It was kind of somebody wore hats in various roles, and it actually was less that we looked for that person, but rather that we had individuals in our organization that fit that description, and we kind of spun them out into such a role that it looked like the easiest way was to give that title.
Yeah.
But you know, I think it's case by case, because there are different organizations, like for example, the universities have entrepreneurs in residence that are more like mentors to the entrepreneurial community.
Right.
VCs have them as a sort of way to find executive talent in between companies, that once a company in their portfolio is lacking that role, you kind of insert them in there.
Yeah.
So I think it would depend on the organization to say whether or not they're effective, or whether or not that is the right name or not for a role, because everyone's got a different definition for that role.
Yeah. So, I mean, I look on LinkedIn these days, and I mean, everybody's an entrepreneur and everybody's got innovation in their title, Toby.
Yeah, no, it's very true. And on one hand, I think that this is extremely exciting because more and more people are kind of understanding entrepreneurship. The cynic in me, though, is that we're misunderstanding entrepreneurship a lot. And so I guess it remains to be seen whether or not this kind of awareness is going to be positive or negative.
So, I mean, that's interesting. Can you expand on that? You know, when you say that about entrepreneurship, what are we misunderstanding about entrepreneurship?
Well, I think, you know, the best entrepreneurs that I know who have figured it out and consistently do it, they're not the glamorous, you know, people that you would think. They, I'm generalizing here, but
Yeah.
a lot of times very humble, very frugal. They actually don't take great risks. It's a myth that the great entrepreneurs take great risks.
Right.
Most of the great entrepreneurs I know are actually very risk averse, but they're very good at hedging, which is it's the opposite of taking risk.
Yeah.
And so, you know, I think Hollywood, and then you get, you know, this cycle of, you know, a successful unicorn getting all the press, and, you know, the VCs talk about it and everybody talks about it, and then you get this generation of young entrepreneurs that look up to that and go, I want to be the next Facebook, or I want to be the next Twitter, or whatever. And instead of actually coming at it from a more authentic point of view, which is, I want to put something out in the world because I'm an artist, and something about the world doesn't work the way in my mind it should, and I want to put it out there, and I'm going to do whatever it takes, and I'm going to constantly learn. That's more of an entrepreneurial mindset than being able to say, look, I can come up with a really killer name, and I can be, you know, I can use all the lingo and brag at parties and stuff like that.
So it's like so I agree with that. So it's
Don't get me wrong, I can use all the lingo, but
yeah, we can all use all the lingo. But you know, like, I think that's interesting. It's almost like the entrepreneurs are the new rock star, the new Hollywood. It's like, and interestingly, when I talk to some entrepreneurs that perhaps I think misunderstand what it's about and say, how's it going, or how's your business going, I usually get an answer of what their head count is, and how much cash they've raised, or even sometimes they offer up their burn rate, which I find is interesting.
Yeah, I think that's accurate, because I think they're, I wouldn't say leading or lagging indicators. I mean, they're indicators that something's happening, and there's something to write about. You know, how much they're burning, how much their headcount is. So, you know, you see articles, we're going to scale up to 100 people by the end of the year. They haven't yet, but that's the plan. And so people think, if they're going to do that, that means things must be going well. But number of hires, how much funds they've raised, how much, you know, they're burning every month, doesn't mean the rest of the business is going well. And it probably means you're going to have to raise another round because nothing ever goes according to plan. Right. So they're, you know, it's very likely that their burn rates, you know, their revenues are not going to catch up with their burn rate. And they're going to have to raise, you know, another $20-50 million round, dilute themselves even more, get more PR and news, and then be motivated and pressured by those investors to increase their burn rate even more, so that they can increase growth theoretically. And it's kind of a vicious cycle once you enter that VC loop.
Right. So. Okay. That's interesting because, you know, from my perspective, when I hear they're going to increase their headcount to 100, I think, Christ, that's a big payroll to meet on Monday. You know, I know Sunday nights were sometimes moving credit card money from one credit card to another to meet payroll. You know, like you need to have some big limits on your cards. That's what goes through my head, right, when I hear that. I understand it's about the growth as well, but I think, you know, you make a good point. It's that vicious circle that people find themselves in. So what do you think, you know, if we were to sort of readjust the thinking around that, what would be the metrics that perhaps that some of these companies should be measuring, you know, rather than a leading indicator?
I think some of the key indicators are customer retention. I mean, obviously, not to say customer count, how many people are using their product, net promoter score type things about how happy. Net promoter score, in as much as it's a representation of the satisfaction of their customers, how many of them are coming back every month.
Right.
I think Toby tells the anecdote that the most satisfying thing isn't when a customer pays you, but rather when they pay you that second check, which means that you've done something not only right the first time, but actually satisfied their needs and probably went above and beyond, because there's always competition trying to take away your customers. Right. And talking about how the culture in your company, you can't keep culture when you're doubling and tripling every 3 to 6 months. It's just not scalable. Yeah. And then talking about even, revenues obviously, but often it's tough because the catch-22 with the revenues is usually you keep those numbers private because they can affect your fundraising round. So that's also why companies don't tout them as often as they probably could or should. Yeah. So I'd say, those are just examples, but yeah.
I think they're interesting examples because both of those things are customers and your culture and your people, and it's all about people.
Mm-hmm. No, I think you're right. Your customers and your employees are locked together in a relationship with you as a company, and you should be obsessing about them more than anybody else, right. More than anything else. And so I think that's encouraging to hear. I think the first few metrics out of Jose's mouth were all about the customer.
I thought it was awesome.
Satisfaction.
Yeah.
So
yeah.
So
I think that's great. Customers, the second check is good because it means you've done something. Because anyone can sell something, almost. I can get you to buy it the first time, but do you buy it and then think, geez, I wish I hadn't have bought this, and that's the end of you? It's when you come back for a second time and say, you know what, that was really good. We're going to come back again. I spoke to Peter Adams from Rocky Venture Club last night, and he said, he wants people to start thinking about what's their second customer. Their first customer is who they're selling their product to. Their second customer is who's going to buy their business.
Mm-hmm. Yeah, no, I like that. I also think sometimes your first customer, you have to be willing to lose them because you haven't figured it out yet. Somebody's willing to take a chance on you, but your questions about who's going to potentially buy them, that sounds like Peter Adams. Yeah. I mean, that's the point of view of I think who I admire a lot, Peter Adams, but that's a good example of different people have different perspectives on what you're doing as a startup. From an investor point of view, like Peter, whose customers are other investors, he's looking at it as, how does that startup get my 10x return for me or my constituents?
Yeah.
And so that's good advice for a startup founder to get that perspective so they can do the work to lay out that plan so that if they need to get investors, they can tell them what they need to know. So, yeah.
Yeah. Okay. So look, thanks very much for your time, guys. It's been great talking to you. I think the customer thing, that like you say, the metrics that came out of your mouth were all about measuring the customer satisfaction, repeat business, net promoter scores. That's all good stuff. So before we sign off, what's sort of next for Boomtown? Who wants to take that one?
Next for Boomtown. We're going to go have a beer over here, and then
That's good.
And then we're going to try to keep doing, try to focus on our customer, which is the startup founder,
the entrepreneur.
Yeah.
We're week 3 of the program, so we have 9 more weeks of spending a lot of one-on-one time with these entrepreneurs, which is really exciting. You build really cool relationships with them, and they go on to do great things, and then they graduate and become part of the alumni community. As I mentioned, we have over 88 companies that are part of the Boomtown family, and now it's really exciting to see them helping each other, and it continues to grow.
And we're gonna
go on.
we're gonna open up our Australia Boomtown soon too.
End of the year.
As soon as we can.
What are you coming down there for, the beer or the surf or all of the above?
All of the above. Yes, we need to get down there. That's all.
So we actually interviewed Annie and Andy from Behaviour Me. That was inspiring. I think that's a I use a hashtag sometimes, problems worth solving. I don't want to see another coffee app, and I don't want someone to start a pitch saying we're the Uber of. And they did neither of those things, right? And they talked about how they can help with behaviour around autism and everything. I think that's just fantastic stuff.
I mean, we have learned over time that there's very little that you can control in trying to pick a future viably or commercially viable startup, but the character of the people, if you can somehow in your selection process hone in on good people that are creative and fearless, intellectually honest, coachable, and then what you end up getting, they may not come in with this idea, but you end up getting something that is non-derivative and actually interesting and generally has a positive impact. And they're an example of this, I think.
So I think, what I've seen today and the people I've met, Boomtown, awesome. I think your philosophy is fantastic. And if we can get a little bit of that back into our ecosystem in Australia, we're going to be all the better for it. So thanks for talking with us, guys. And thanks for having us.
If anyone wants to reach out, feel free to send us a message. We'd love to help entrepreneurs. Is what we do.
So
Boomtownaccelerator.com.
Boomtownaccelerator.com, and we'll stick the links into the comments. And
my email is Jose@boomtownaccelerator.com, so I'd be glad to help.
Jose@boomtownaccelerator.com. So there you go. There's an invite to connect directly with Jose.
Or tweet at me.
or tweet at him or whatever. Thanks, guys. That's going to be a wrap for us for the day. We've had a long day, and we're heading out of town tomorrow. And we're going to San Francisco. So
Thank you, Nick.
Thanks, guys.
Safe travels.
Cheers. Thanks very much.
Thank you.